Good morning, good afternoon, good evening, family. Today I'm just going to explain how I use exponential moving average to enter into trades, and specifically, I'm going to use the 50 and the 200 EMA just to try and explain how I entered a trade this week for GBP AUD. So this is my platform for GBP AUD. I'm first of all going to um, just highlight, zoom out so that you can see. I was looking at this trend line because price had already hit the trend line on a 4-hour time frame and reversed, and again hit the trend line on a 4-hour time frame. And from this one, I was categorically sure that price was on a downward trend. So I was looking for exact sell opportunities. And normally, when you're using the EMA, you use the golden cross and the cross of death. By golden cross, it just means, let me just remove the 20 EMA first so that we just remain with the 50 EMA and 200 EMA. So when you're using the slow moving EMA and the fast moving EMA, what traders basically do is you wait for when this fast moving average crosses the slow moving average. And in this particular scenario, there was a this was where the golden this was where the golden cross is at this level here. So that's when uh, that 50 EMA crossed the 200 EMA. So a person who entered this trade at this particular level, which means he stayed in this trade, you stay in the trade until when the slow move price comes to the slow moving average. So this person who entered this trade stayed in all this trade all the way up to this level, and he got out. So having done that, he looked for another slow opportunity when price went back again and stayed and got up to here. So I was looking at this and was looking at a place to enter the trade. So I'm just going to replay because I'm trying to backtest the strategy and see how it all went. So if I play the trade, how it went, so the trade reached here, price went back, and once price reached here, it reversed. I went back again. So when it went back again, for me, I was using this as a first confirmation, because what you usually is done is price will hit the level, come back, retest itself. So for me, this was my first confirmation. It went back, the sellers came into the market and it reversed again. And for me now, this was a perfect confirmation that the market had already confirmed twice that it's going to go down. So I stayed into the trade and waited for the perfect opportunity for the cross of death, and it exactly happened at this level here. So I ended up getting into the trade at this particular level, which was on 23rd of February, and price moved all the way for the remaining part up to yesterday when price reached here. And if I look at it, if I want to measure the amount of pips that I've gained from that particular one move, that's almost 380 pips. So and I'm still in this trade, so because it's here, so that's not 380, it's around 350 pips. So I'm staying in this trade, and I'll continue staying in this trade until when this slow moving average again will cross the fast moving, when this fast moving average, sorry, will cross the slow moving average. Or alternatively, if price comes back and hits the slow moving average, which is the 200 EMA, then it will be for my time to get out of the trade. And exactly as I explained here, that you stay into the trade until price hits the slow moving average, and that it's an indication for me as a trader to stay out, to get out of the trade. So because I'm swinging the trade, I'll continue staying in the trade as long as it takes until I get a confirmation. And if you're using TradingView, you can as well use alerts to alert you exactly when or if price crosses this exponential moving averages. You can get the alerts on email, or you can get alerts on SMS on your phone, or it can pop up on your application, trading view app on your mobile phone. So that is it, family. So I'm still in this trade. I'll still continue holding it and continue looking for other opportunities to get into the trade. Thank you so much, and that's how I use my 50 and 200 EMA.